world's second biggest economy, is facing major problems. China's stock market is seeing a stark contrast to the US market, which is now reaching record highs. Since the 2021 peak, Chinese stocks have lost over $6 trillion, and the sell-off keeps getting worse. Yes, $6 trillion are gone. As of now this year, China has been the worst performing major market. In fact, things are getting so bad that Tokyo has surpassed Shanghai as Asia's largest equity market. The local asset management sector in the nation is also not doing well, as the collapse of Chinese stocks has resulted in the greatest number of mutual fund closures in the previous 5 years. Looking at data that compares the MSCI World Index to the CSI 300 index, it is clear that China's largest corporations have experienced a massive sell-off since Q2 of 2023. And here's a genuinely crazy statistic. The price-to-book ratio of the NASDAQ is currently higher than the Hang Seng P ratio. That is astounding. Regretfully, China's situation is dire. When it pours, and there are several important factors contributing to this, making it unlikely that the nation will emerge from its current predicament anytime soon. First, there are severe deflationary pressures brought on by the incredibly slow post-COVID recovery. Therefore, in contrast to the US, China has had significant difficulty reviving its internal market for products and services following strict lockdown measures, which has resulted in a generalized deflation of the Chinese economy, with the consumer price index declining 0.3% in December from a year earlier. Consumer prices have now experienced their greatest dip since 2009. China's economy-wide prices are experiencing their longest decrease since 1999. According to a Bloomberg analysis published last week in Q4 of 2023. That metric, which Bloomberg computed using the gap between nominal and real GDP growth, went into contraction for the third consecutive quarter. Chinese businesses are under a lot of strain because consumers are just not spending their money after falling 3% in November. Factory Gate, pricing the amount that a manufacturer quotes for goods and services before adding taxes, shipping, or other fees, fell 2.7% in December. Due to decline in commodity prices and sluggish demand both domestically and internationally. These prices have been declining for more than a year. Indeed, the decline in Chinese exports over 2023 was 4.6%, the first-year decline since 2016. This is concerning given the significant role that exports play in the Chinese economy. Chinese exports are becoming less valuable, which lowers their cost to outside buyers. The export price index fell to its lowest point since 2006 in October and only marginally increased in November. For the past 6 months, food prices in China have also decreased. Overall, the persistent deflation in the economy is making economists question if the government will ever implement any significant stimulus. Yes, what I said was correct. China's predicament is different from most other countries in the world, where high interest rates are being used to cool down a rapidly expanding economy. In an effort to boost the economy and encourage a price recovery, China's central bank has promised to increase macroeconomic policy changes, but the rest of the world is still waiting for the CCP to actually do something. China's issue is that the country's economy has consistently low demand. For this reason, prices are also quite low. They constantly claim they want to strengthen consumption and bolster domestic demand, but they never follow through on the actions that will truly do it. The greatest way to put it was by Raymond Yun, chief economist for Greater China at AZ. China needs to act boldly to break the deflationary cycle. It will fall into a negative spiral otherwise, and that's where deflation gets problematic. If unregulated, it can spiral just like inflation. This is exactly what happened in Japan in the 1990s. Declining prices caused production to decline, salaries to decline, demand to shrink, and so on. Economists therefore urged the Chinese government to intervene and offer some assistance, and many anticipate that this will take the form of interest rate reductions. On the other side, the Chinese government may have different ideas. The People's Bank of China chose to maintain interest rates at current levels, defying expectations for most analysts that it would cut rates on its one-year policy loans known as the medium-term lending facility to 2.4%, a 10 basis point decrease in the first rate cut since August 2023. They made the decision to take no action. This confused analysts since, without a doubt. Deflation is a serious issue that the Chinese government needs to address right away. Given their startling new economic figures, it is even more clear that some kind of stimulus will be required. With a 5.2% GDP growth in 2023, China's economy continued to expand, which was better than the 3% growth in 2022. That achievement, however, is the lowest growth since the 1990 recession. Excluding the pandemic years, the GDP increased by just 1% on a quarter-by-quarter basis, which was a decrease from the revised 1.5% growth in the prior quarter. And if we dig deeper, we can find some December indications that were revealed with the GDP statistics to be concerning. The most obvious one has to do with their real estate industry. The unexpected development was the change in government policy from supporting large real estate developers' debts to letting them fail. Since then, dozens of private developers have failed, casting doubt on the state of the Chinese real estate industry as well as the country's overall economy. We have all heard about China's troubled real estate market by now. To give you a better explanation, I even prepared a film about it which you can watch here. However, the crazy thing is that things have become worse even after that video was released. Evergrande, the second largest real estate developer in China, filed for bankruptcy in the US, and we recently learned some more worrying information. China's new home prices declined for the 6th consecutive month in December, doing so at the fastest rate in almost 9 years. Therefore, the truth is that people aren't purchasing homes at this time due to everything we just covered. Sales of real estate are declining and the wallet is feeling quite empty. Property sales by floor area decreased by 8.5% year over year, according to NBC.